Thank you for joining me today. I'm Dalton Green of Green Financial Online Inc., and this is Tax in 10. Today we will address the endlessly asked question, should I invest in an RSP, a TFSA, or pay down the mortgage or debts in general? I'm sure to get either thanks and praise for today's Tax in 10 or hate mail. Either way, people will have to think about the math behind their decision versus parroting a sales pitch the government has been vomiting on us for over 40 years. As always, I do not give investment advice. I do demand that people around me use math to support or discredit any position. Although current customers have heard me rant and give opinions on politics and the economy, I never act or tell others to act on my opinion. It is always math-based. So let's begin by upsetting some people right away. Number one, RSPs. They are a terrible thing to do with capital, and they have terrible math behind them and should not be used by anyone, ever, for any reason. With one exception. Basically, what you invest in when you put capital into an RSP is not what I'm talking about. You can leave cash in an RSP account or buy ETFs, mutual funds, penny stock mining shares, puts, calls, futures, real estate income trusts, etc. Invest in what you want to, it's your capital. The RSP is the problem. The issue is the RSP umbrella you purchase these investments under. RSPs offer an immediate tax reduction on the amount contributed every year. The actual tax savings you will see depends on your overall net income level. The savings can vary year by year for the same person as their income and expenses rise and fall, and as the tax rates change year over year depending on the Prime Minister in office. So if the problem is not the investment vehicles you choose or the benefit of an immediate tax refund, what is the problem with RSPs? The problem is at the back end or exit strategy that the RSP salespeople, i.e. the federal government, will not tell you. I can explain this in 3 easy steps. Step number 1, your tax rate will only increase over time. So if you save 30% today, only to pay 50% when you take this capital out of the RSP 20 years from now, that is a terrible investment strategy. For example, the top tax rate on a personal return in British Columbia in 2010 was 43.7%. In 2020, the top tax bracket in BC was 53.5%. That's a 22.5% increase in personal taxes in 10 years. If you put your capital away for 20 or 30 years, what will the tax rate be when you withdraw it? This investment strategy is doomed to failure because of the tax rate changes that will occur before you retire. And remember our friend inflation. Your purchasing power evaporates over time anyway. That specific topic is addressed in detail in the Tax in 10 video called Currency versus Money, the Inflation Trap. Back to RSPs. Step number 2, the loss of all tax credits when you withdraw capital from your RSP account. If you invest in the stock market and make capital gains or dividends, you get capital gains tax credits or dividends tax credits. In addition, if the capital gains are on an eligible capital property, you'll enjoy a 0% lifetime capital gains tax exemption. At time of this video, the lifetime capital gains exemption is $883,384. But if you're taking capital out of an RSP account, you lose all those tax credits. None apply, regardless of your age, gender, province, type of company you own or work for, etc. All capital withdrawn from an RSP is called income, the highest tax form of money in Canada. Step number 3. Since 2001, I've made 30-year tables comparing 2 people who invested $100,000 each. They received the same returns every year, but one was under an RSP umbrella, the other in a normal investment account. The person inside the RSP realized both the immediate tax refund and protection from all taxes for the 30 years. The person outside the RSP was a foolish investor who sold the entire portfolio every December, which generated commission fees and income taxes. They then repurchased the entire portfolio every January, paying commission fees on all assets again. After 30 years, the fellow in the RSP had much more capital than his friend. But then they started to withdraw and spend this capital. The fellow outside the RSP was already after tax. The fellow in the RSP had to withdraw the capital first. Using 2001 tax rates, and these are much lower than both 2010 and 2020 rates, after 3 years, The fellow outside the RSP had more capital to spend because of the difference in taxes. But the capital was not all withdrawn in 3 years, so the fellow from the RSP kept getting punished year after year, leaving him with a fraction of capital he would actually spend compared to his friend whose investments are outside the RSP. All because the 100% of the withdrawals from the RSP are taxed as income, whereas capital gains and dividends outside an RSP have large tax credits. Now let's look at TFSAs. TFSA stands for Tax-Free Savings Account. The name alone causes problems as people think you can only put cash into it like a bank savings account. You can invest in the exact same things as an RSP: shares, mutual funds, puts, calls, ETFs, futures, etc. The difference between the two is that the TFSA has the exact opposite input and exit strategies. There is none, zero tax benefit for contributing to a TFSA. But there is no tax on any of the withdrawals from a TFSA, and that makes all the difference in the world. If you put the same $100,000 in a TFSA with the same return as a fellow in the RSP, and again, you can buy the exact same investments as the RSP, you can withdraw $1 million no tax. This is literally manna from heaven in the financial world. There is no math on the planet that will prove an RSP is a better investment than a TFSA. It is mathematically impossible. Remember, when Prime Minister Harper left office, he raised the annual contributions to TFSAs to $15,000 a year. The new PM immediately dropped that to $5,000, saying that people had no capital left over after filling their RSPs. His advisors could see how bad TFSAs were for the government, which automatically means they are great for you. There is an oft-repeated argument that people keep repeating when defending RSPs over TFSAs. Unfortunately, it does not have the support of math. The argument sounds like this: if I reinvest the tax savings, it will offset the extra taxes I will realize when I withdraw the capital. Nope, that will never happen. Not one person in all of Canadian tax history has ever achieved consistent reinvestment of tax savings. Job loss, health issues, having kids, getting divorced, a pandemic. This world will throw so many things at you between now and retirement that only a government employee could ever think a straight line graph could actually exist in the real world. Not only do they think straight line graphs exist, but they also tell people to invest over decades on the assumption that this is possible. That line of thinking has zero grasp of reality, and you should avoid people that say foolish things like this. It does not matter if that person is a paid professional, a government official, or a relative. The math always wins. The one exception I mentioned earlier: women who stop work to have kids benefit from contributing to an RSP. Mathematically, yes, RSPs work well for people who intend to stop working for a period. It does not have to be having children, but it is the one situation where people who go down that road almost always commit to that course of action. Many people have tried to stop work to tour the world or write a book, but it didn't actually happen. But having a kid is the most assured reason to make someone stop working and stick to it. So that was RSPs and TFSAs. How about doing neither and paying off all debt first? Yes, that is the best choice. There is nothing mathematically better than paying off debt. For today, for tomorrow, for retirement, being debt-free should be step number one on everyone's list. Why don't we? Here are the biggest mistakes people make when getting out of debt. Number one, paying off the highest interest rate debt first. That doesn't work. The best mathematical method is to pay off the smallest debt first, then use the monthly amount you used to pay this debt with to help accelerate the payment of the second largest debt, etc., until you are debt-free. Number two, the second mistake people make is not rewarding themselves. Remember, when you pay off debt, you have less income to have fun with, and all you have to show for your efforts is an account that has a $0 balance. It used to be negative $5,000, but it is now zero. A great success, but your morale will drop like a rock because all you have to show is zero. Zero is linked to nothing in your mind. Even a negative $2,000 on a credit card will remind you of the great computer you bought and all the great things you can do with it. But $0 is linked to nothing and is interpreted as, I have nothing. It is the way humans think that you must guard yourself against. Reward yourself every time you eliminate a debt account. Rewards can be a massage, a great meal, a small trip, a sports or arts performance, whatever you like. It must be enjoyable and encourages you to do this again. If you don't reward yourself, you won't do it again. The studies are in, this is what will happen. When you are out of debt, you can build investments incredibly quickly because aside from food, shelter, and transportation, the rest of your income is now free to be 100% directed towards your goals. I and everyone at Green Financial look forward to helping you. Thank you for watching this video, and if you need a tax professional or bookkeeping services to help you with your situation, please contact me at one of the following.